In this budget 2018, long-term capital gains tax is reintroduced. Since this announcement, the stock markets have been in a turmoil. Let us understand what has really happened and how does it impact you. Firstly, you would know that long-term capital gains comes into existence when you sell a stock or a mutual fund after holding on to it for more than a year. Till now, this gain was tax-free. Finance Minister now has introduced a 10% tax on this gain with a grandfather clause. This clause means your gains till 31st January 2018 has been protected. So whether you bought the stock or equity fund 1 year ago or 10 years ago, the profit accrued up to 31st January 2018 is protected. For computing capital gains in the future, you have to consider value of your portfolio or that particular stock as on 31st January 2018 as your purchase price, and any appreciation above this value is your taxable gain. Also, the capital gain thus booked is free up to rupees 1 lakh per year. Call it a knee-jerk reaction or panic. Some investors are booking profits now to evade tax from the new financial year. Many are confused whether to hold on to their investments or sell off. Many do-it-yourself investors are getting onto the different blogs. They are going through a lot of calculations to decipher the long-term impact. The noise on long-term capital gains tax is only become louder by the day, creating more panic and confusion among its investors. Firstly, let us accept the fact that taxes are here to stay. Be ready to pay more if you are earning more. Governments will change and so will budgets, for better or for worse. We do not have any control on it. What you can control is your investment strategy. You can start by letting go of your obsession with the taxation part. By the way, did you know long-term capital gains tax was prevalent before 2005? So this is like you had a 12-year tax holiday which got over just now. Introduction of the long-term capital gains tax is one of the budget things which keep happening. Sometimes beneficial, sometimes adversely affecting. Remember, equity is still one of the best asset classes helping you create wealth over long term. The only change now that has happened is that a return which could be 15% after tax has become 13.5%. It is still a phenomenal return when compared to other assets whose returns do not even reach double figures. Your decision to sell equities should be aligned with your financial goals and not on adverse budget announcements. An annual tax-free limit of rupees 1 lakh on capital gain may tempt you to book profits once your long-term capital gains near that 1 lakh rupee mark. But if you keep booking those long-term gains intermittently, you will lose out on the benefits of compounding. The opportunity loss to earn more through compounding would be huge compared to the paltry 10% tax you would pay in the long term. To conclude, do not take a micro view of the budget by just focusing on your personal taxation rates. Any government would just do their job of balancing revenues and expenses like we do our household budget. So if equities help you to beat rising prices and in meeting your financial goals, you should be happy. Then the budget becomes a non-event. I'm Yogin Sabnis. Thank you for watching.